All righty, welcome to week 5. We're officially into the second half of the semester. So just to kind of give overall comments on last week's discussion board, I enjoyed reading each of y'all's ideas about the integration of faith into business and how Chick-fil-A has successfully done that to receive a premium. One overall comment is that now that you've taken this course, I hope that you can use what you learn here to be a little bit more specific on how you present statistics related to financials. So one overall comment, McDonald's made $21 billion in revenue in 2019. Compared to Chick-fil-A's at $3.8 billion. So when you say Chick-fil-A makes more money than McDonald's, it really depends on how you look at it. It's based off of per store, yes, they do, and it's because of the premium that they make. But McDonald's is still a much larger operation and still consolidated a bigger approach. Okay, so with that in mind, let's get into week 5. So going into course content, should be used to it by now. This week we're going over chapters 9. You have your readings, you have your presentations, the know-how videos. We will need to go into the learning activities and assessments. In here, have a discussion board. So this week's discussion board is discussing the difference between the write-off approach and the allowance approach. And so we'll get into that after you have the Learn Smart assignment and the homework assignment. So on the discussion, I do want to remind everybody, last week I did take the week off on giving points for citing your sources. That's because last week's discussion was more faith-based and on your personal thoughts. This week is something that you should research and show support for. Again, when you're asked a question, it's okay to provide an answer, but you need to be able to back that answer up. And to do that, you have to come up with either, you can all go to the website and have the gap listing and use that as your support, or any news articles. But I need to see that you came to your support based off of research. All right, so when we go, so again, this week we're still in that identifying a transaction and learning how to record it. We are focusing on the concept of allowance for doubtful debts. And I made this little chart, and I would expect this to become a flashcard as you're defining each of these. I want you to know that both the direct and allowance only exist under the accrual method of accounting. And that's because if you use the cash method of accounting, we're not going to record the sale until we receive the cash. So there is no accounts receivable. And so there is no concept of reducing that revenue to match up. That being said, under the accrual method, we do have two specific ways of doing this. We can either do the direct write-off or we can do the allowance method. Problem with the direct write-off method is if that we think of ourselves on a timeline here, and excuse my drawing, not the best, but if we have just a simple timeline and we make one purchase here, then we're going to submit our financial statements here. Then we're going to determine that a part of this accounts receivable is uncollected. Okay, so if we go back to the accrual method, the purpose of the accrual method is to match up the revenue to the expenses. So we want to be in the same period where we have the revenue, the sales, and we have the expense, the bad debt. So because of that, we want to make that expense known the same period that we record our revenue, Otherwise, these financial statements are now wrong, or at least not as accurate and up to as we can. So that's why GAAP will favor the allowance method. Doesn't mean the direct write-off method won't be used from time to time, especially if a write-off in that general field is considered so unlikely or happens so rarely with historic evidence that the estimate of which just cannot be known. Other than those circumstances, we'll use the allowance method. And under the allowance method, we have two different ways of approaching this. And this is going to get confusing because if you don't know the reasoning of each, then when we do the calculations, you're going to get confused. So one method is what I call the income statement or the percent of sales. And just like it sounds, we're going to take a percent of our sales. Sales is on the income statement. Okay, so when we use this, we're going to actually calculate what the journal, what the income statement impact is. It's going to be different in a second. On the aging method, the aging method is going to take our balance sheet item, our accounts receivable, and use that to calculate what our balance needs to be. What I mean by that is when we look at these calculations, and again, I told everyone at the start, we're not getting complicated with our formulas. We're actually going to reuse the same one we did for inventory. Beginning balance plus additions minus usage is going to equal our ending balance. That's just a general roll forward. So we're going to use that formula for a lot of accounts. When we use the percent of sales method, the number that we get when we calculate based off of a percent of the sales will be the additions. And because of that, that is the amount that's going to be on our journal entry. When we use the aging method, we use the balance amount. So when what we calculate is the actual balance. And when we have that balance, we then need to end up backing into what our journal entry needs to be. Okay, so we'll have a beginning balance. One way or another, we need to calculate what the addition to that is, what our bad debt expense is, what we're going to say our expense for this period is to make up for future write-offs. We will probably end up having a write-off, so we're going to be decreasing that balance because as those become collected, we're going to need to net them out. And then that's going to get to our what the ending balance is. What do we think of our total AR? What is uncollectible at this point? And if you look, again, going back to our initial equation, assets equals liabilities plus equity, we know AR is an asset, but at this point, we're not ready to remove the AR. We just want to put an allowance on it. What that means is we're going to reduce it by an estimate of what we think we won't collect. And so the allowance for doubtful debt account is going to be sitting within the asset account, but there's this negative here, and that negative means it's flipped, okay? So it's going to have a normal credit balance, and it's going to reduce assets, okay? So when you have your T account and when you have your flashcard, you're drawing an arrow up on the credit and down on the debit. When we use it, that's a debit. When we add to it, that's a credit. At the same time, under equity account, we know equity is our income minus expenses. Bad debt expense. What do you think that is? That's right, it's an expense. So again, it's on this side of the equation, but it's negative. So that means the debit is going to increase it, credit's going to decrease it. Makes sense. These are going to go opposite of each other, right? Alrighty. So with that in mind, let's get into the homework. And let's see this in approach. All right, here we just have a transaction. The transactions are going to be sold in cash and credit. But when we make that credit, we're using a debit card, and therefore we're getting an expense. So the amount of cash in the door has actually been reduced. We're still able to tell the customer, hey, this is our sale price. So we're going to record the sales at the full value, but we're only getting the reduced amount because using that bank card, there's a fee. And you know that's why the gas stations or something will have a minimum credit card, is because they're getting a fee on each one of these, and it's just not worth it if you're not buying more than a certain product. Okay, so when you do that, that's going to be a 4% charge on the SunTrust and a 2.5% charge on the Continental. So when we use the SunTrust, we're going to record the full value of the sale. We're going to multiply it by 4%, and that's going to be the expense. And then the net of that is how much cash we get. Okay, so cash is the asset that's going up. Expense is an expense. Debiting is going up. Sales is the income. On the credit side, we're increasing. Okay. We never make a sale without having cost of goods sold. So the question is here, that sale cost us this much to make. And again, this could be using weighted average, LIFO, FIFO. They tell you that the cost of that good was this amount. So we're going to increase our cost and decrease our inventory. Notice here, one sale, two transactions. Every sale has two sides of it. The sales side where you're generating the revenue, and the cost side where you're creating the debit. You're creating the cost. You're matching the expense to that revenue. Right. And then here it's just a recalculation. Total amount times the access fee. The net of those two is how much cash is in the door. And then you record the cost. All right, so that was it when you use a card that gets processed automatically. Here we're going to use a card that then they pay at a later date. So that sales, we're going to record the total amount of the sale, and we're going to increase accounts receivable. Again, one transaction, two records. The sales side, sales and AR go hand in hand, and then the cost of goods sold versus inventory. We're moving the cost from inventory into our income statement, matching up revenue to expense. And because they use the store credit card, they tacked on 4% of interest. Okay, so we're increasing AR by $4. That's not a sale. It's because of the way they finance this transaction. So we're going to record that increase as an interest revenue. Still a revenue account, so it's still going to be increased by credit, but we're going to keep the sales side separate. All right, so then we're getting into bad debt. So we've determined 51,000 of it is uncollectible, and we're using the direct write-off method just to get that going. So on October 30th, so we already wrote this off on October 1st. We're now here on October 30th, and they've actually paid us. So sometimes our estimates come in wrong, and we get more than what we expect. Sometimes it's halfway in between. Anyways, we need to first reverse out that transaction. So when the transaction first occurred, we increased our debt because we're doing the direct write-off method. So we're going to only record the expense when it happens. We're going to increase our bad debt expense, and we're going to reduce our AR. We need to reverse that now. So we're going to increase our AR because we now think that that's going to be paid, and reduce our bad debt expense. Then the cash gets paid. So cash is an asset increasing, and that AR is coming back off. Okay. We always want to show these two separate as two separate transactions. One is reinstating the bad debt, then reducing the AR through the cash. Okay, and that's to keep it separate in our records that we have a reversal of this transaction and then what would have occurred. All right, we're still in the direct write-off method. We first determine 8,800 is not going to be collected. So at that point, direct write-off says we're going to record the expense at that point. So to record the expense, increase expense to debit. And again, we don't think it's going to be collected, so we'll go ahead and remove it from our AR. Okay, removing an asset is reduction as a credit. Then we pay it. So again, we're just going to reverse this transaction when it pays because we want the record of it being in, then going out. So we just flip the debits and credits here to reverse that, increasing our asset, decreasing our expense. Then we make the transaction of just moving the asset from AR to cash. And this has a zero impact on the balance sheet, but it's moving from AR to cash. Okay, again, just recording the same transaction. Okay, so here we're getting into the allowance method. We're going to be using 0.2% of sales, so percent of sales. So it's just a simple straight. We use 0.2 times 995. That's going to get us to this 1990. Okay, that is the journal entry amount. That is right here the addition. Okay. Then we're going to write off. So when we made that calculation, we increase our expense by that amount, therefore increasing the balance of this contra asset account by that amount. Then we're going to use it. We decide that we're not going to collect anymore on 500 of 498. So then we're going to reduce the allowance and reduce AR at the same time. This part right here has no impact on the P&L, no impact on the balance sheet. Decreasing a contra asset account and decreasing an asset account, so the impact nets out. The expense was already recorded when we made the allowance. So then when we decide that it is getting paid, we can just reverse it. And if it didn't have any impact on the balance sheet, didn't have any impact on the P&L, when we reverse it, still doesn't. Then we add the cash, still doesn't. The P&L and the balance sheet is impacted only when you do the estimate. That's because we already matched it. At this point, it's just a classification of what asset, what contra account is it in. Requires an estimate allowance. Again, the direct write-off says, let's wait till it actually happens. So then when you write it off, the allowance method has already had the impact, where the direct write-off is when you'd have the net income impact. So again, this is just the opposite, so the answer is going to be the opposite instead of does not, does. Again, the matching is going to be the allowance. Again, that's the purpose, is to match the loss with the revenue. And yes, we will have to make an adjusting entry because we're not going to be able to make that estimate until we know either what the sales were for the whole period or what our ending AR balance is. And again, the contra asset account only exists when we're using the allowance, because we're going to use the contra asset while it's an estimate. And then once we come to the realization it's going to incur, then we use it. Direct write-off, we're not recording it till we know, so there's no need to have that placeholder. All right. Same thing, we're preparing the entry for writing it off using the allowance method. So we already recorded the expense at this time. We're now writing it off, so decreasing the contra, decreasing the asset. Then we're going to reverse that, pay it back. Again, accounting is very repetition, but it's very important you go through this to make that part of your memory. All right, so here we're calculating the balance sheet approach because we're going to take the accounts receivable, which is a balance, and we're going to use that to calculate this number. So it's very easy when you go through this calculation to get to the point of, I created the number, I'm going to use that for my journal. When you're using the AR approach, it's a two-step approach to get to the journal because you're calculating the balance. The journal is the addition, okay? So last time we used percent of sales, that's the journal, okay. The AR methods is a little bit more specific in it because when you use the percent of sales, that's not taking into account which customers have already paid and which customers still have outstanding balances. Some of those balances might be really old, some of them might be new. You're just saying that on average, this is the percent of our sales that becomes uncollectible. Doesn't mean it's not accurate, it just means that you're using one approach over the other. The AR is going to be a little bit more specific, and it's going to say, this is what my ending balance is. And usually, not always, but usually you'll take the assumption that the longer that invoice has been in your aging, the more unlikely it is that you're going to collect it all. So you'll see here in this calculation, as the balance increases in age, the percent uncollectible becomes higher. Okay, some companies will still just take an average of the AR. That doesn't mean that they're using the percent of sales approach. It just means that they're using a simplified aging method. So yes, you will be taking percents and multiplying them by a number, but what that number is determines how you use that information gathered. When you take that percent and multiply it by a balance sheet account, AR, you're going to get the balance sheet number you need. You're going to get what the contra amount should be. Because of that, you're going to back into the journal entry here. Okay. If we took this percent and multiplied by sales, the sales number, and I know I'm a broken record here, but I'm sorry, but the sales number would be the journal amount, and then that would go into the calculation of what the ending balance is. Okay. So here they tell you what the percent is, what the balances are. You multiply those straight across, add them up. This is what the balance should be. So in this situation, we have 19,545 here. It started the period at 14,645. Oh no, so that is the balance right now. So what that means is they've already told you what the beginning balance and the write-off is at this point. They're saying the two of those together is currently 14,645. You calculated that it needs to be 19,545. Remember, this is a contra asset account. So in order to make this balance equal that balance, I need to credit it by the 4,900. I'm going to credit my allowance for doubtful accounts. The opposite account is going to be the bad debt expense. It will always be the allowance for doubtful accounts, and it will always be the bad debt expense. Be careful though, because sometimes you might actually debit the allowance and credit the expense if you ended up having a large amount of older items paid off than initially expected. Then the next time you did this calculation, this could actually be less, and that has happened. So go through this calculation. What the balance is minus what the balance should be. If it's negative, credit the allowance account. If it's positive, debit the allowance account. And that's because it's a contra asset account To increase it, you need to credit it. To decrease it, you need to debit it. Okay. And here, we're going to use percent of sales. So we'll take the 3%, multiply it by the number of sales. Realize, cash sales, we don't have an allowance on cash sales because there's no, they give us the cash at that moment. Okay. So anytime they give cash sales, don't worry about it. We're going to be worried only about credit sales. Okay. So 3% of credit sales, take 3% times the credit sales. That's going to get you 105,510. However, sometimes it's easier, sometimes we don't know the difference between cash or credit. Everything's just recorded as a sale. So when we come up with our estimate, we know it's an estimate of our total sales. Okay, so be very careful of how they define this. We will never take an allowance for just cash, but if we build our estimate, build our model based off of total, then we're going to have to add them together. So here you add those two together, multiply by 2%, you'll get this number. Again, we're always going to hit the bad debt, we're always going to hit the allowance. Because we're using the percent of sales, this tells you what your income statement amount is, which is your journal entry. Here, 6% of year-end accounts receivable. Okay, so here, percent of AR. AR is a balance sheet. We're using the balance sheet method. We're using the aging method. And here we say the balance is 28,790, which means they've already told you what it is, which includes what the beginning balance is and how much they've used it for the period. Because before we've done this adjustment, this is what the balance is. And I need it to be 6%, and do 0.06, or you can put it as 6%. Sal knows how to do it both ways, times the ending AR balance, 1065651. To the number now, 651. Oh, it's very important to pay attention to the debit or credit. Somehow, because of the usage of this, this has actually become a debit balance, which is considered a negative contra. Okay, because what happens is last month their estimate undershot the actuals, and because of that, the number of write-offs that occurred during that period is higher. So it's actually sitting at a debit. And then they want it to be an ending balance of this. So because of that, the total expense is going to be that amount. Okay, you calculated what the total balance is compared to what it is now. That's the adjustment. Okay. And they just want you to see that what we're going to present on that is the net AR, which is the debit balance of the accounts receivable plus the credit balance of the allowance for doubtful accounts. The net of that is our net AR. Okay. Same thing there. And this time we calculated this balance. Here, you have to calculate that balance by taking the journal that you made plus the debit that you created that was already there. Okay, so realize they will ask you sometimes for the balance sheet, and that's you've already calculated it here. If you have this number, you then have to go and calculate it using that. All right. And that completes it. I hope that was informative. Sorry about the broken record, but it is very easy to get these confused, and it's very easy to just go through your calculations and plug in the numbers without thinking through. You have to know which side of this are you on. Because of that, it's going to be very similar. You're taking a percent, you're multiplying it by a number. But what that number is determines what that number you get. Okay. All right. Y'all have a good week.